It's good to be here today, and hopefully we'll learn some things about changes to the estate tax and gift law, so we'll be ready no matter what Congress does as we move forward. I wanted to just kind of tell you a little bit about what we're going to talk about today. Obviously, we're going to talk about the proposed legislation, and then the way I want to handle dealing with and getting our arms around all of the different possibilities is to go over what's more likely to happen, and then things that are not as likely to happen. And then once we've dealt with that, I want to talk about some techniques that can provide some flexibility so that you can start doing some planning now. And if the law doesn't change, you're able to bend and flex to the fact the law didn't change. And then also some techniques that we should all be doing all the time as part of our estate planning, whether or not the law changes, in terms of trying to minimize estate taxes and also provide an inheritance to family in a way that doesn't make them worse off or make them trust fund children. And then we'll conclude with some closing thoughts about where we go from here. So that's the agenda. We'll start with the Senator Bernie's bill. It's called the For the 99.5% Act. It says its effective date will be January 1, 2022. And that's only a few months away from a planning point of view. But be aware that the March 25, 2021 filing date and the date of enactment could be dates that are used for the effective date of the bill. So some things, since we're obviously past March 25th, may be affected by this law, even though the law is not in effect yet. And some things we may have some time before Congress actually acts to vote on these bills. So just keep that in mind. Now the one big top level change to Bernie Sanders' bill is that he reduces the estate tax exclusion to $3.5 million. And that's not indexed. So I'll talk a little bit about what that means. That's a 70% drop from the current $11.7 million estate tax exclusion. So it's a huge drop in the exemption, and it will pull in a pretty large portion of the population, and certainly many of our estate planning clients. The other thing is that it's not indexed. So for example, the current $11.7 million exemption started out as a $10 million exemption. And then as it was indexed for inflation, it's now increased by 17%. So you can see that $3.5 million exemption will pull in a lot of people now, but then going forward, it will pull in more people every year as inflation eats away at what the 3.5 million exemption is. Now, the other big thing that happens in the bill is it's going to reduce the estate tax exclusion to $1 million. Under current law, the estate tax exclusion and the generation skipping tax exclusion and the estate tax exclusion are all the same number. This would shift that and change the number for gift tax to $1 million. And again, not indexed for inflation. So that's a 90% drop from the current number. The other thing it will do is increase the estate tax rate from 40% to as high as 65%. And then eliminate valuation discounts for certain non-business assets. And then they want to tax Grantor Trusts as assets subject to estate and gift taxes. So, and then finally change the rules for Grantor Annuity Trusts, or called GRATs, sometimes called GRATs. Change the rules in ways that make it much more difficult for especially older people to use these techniques to eliminate their estate tax bill. And then the last change in this bill that's is probably significant is that it would cap the annual gifting to trusts to $30,000 total, and that's indexed. That is indexed at $30,000. So right now, people can give $15,000 per person per year and not have to file a gift tax return, and it's not a taxable gift, and it doesn't use up their exclusion. And where people routinely will see this is an irrevocable life insurance trust, where the annual premium is, say, $40,000 per year. They have 3 children. They gift the $40,000 in. The children have something called a crummy withdrawal right, which makes the gift a present gift. and then each child's $15,000, so they can have a premium as high as $45,000 per year. Again, no taxable gift to fund the trust. Under this rule, under the example I just gave, there would be $10,000 of that annual premium would be a taxable gift and would use up exclusion. It doesn't change the outright gift rules. And then the other thing I wanted to note, and this is the items on this slide that have the little star by them, the asterisk by them. All of those provisions have been vetted by the Congressional Budgeting Office for the cost they will result to in Congress and to the United States, or the revenue that would be raised by making the change. And in the current environment where Congress is looking for revenue to fund different statutes, these items marked with a star are at a greater risk of being dropped into a bill because they're already rated for cost and revenue, and they can be used to raise revenue to pay for other things. And so that's something to keep in mind. And as an example, in 2019, on December 23rd, something was dropped into a bill that required that IRAs no longer had a stretch out for the life of the owner's children or grandchildren, but instead had to be paid out over 10 years. The reason that was dropped in was because it had already been cost benefit and cost revenue vetted, and they knew that it would raise X amount of money, and so they were able to pay for something else by doing that. So those items that are marked with stars really do need to be careful and keep an eye on those. Now I'm going to switch over just for a little bit. Senator Sanders' bill is an actual bill that's filed with Congress. President Joe Biden has also made some proposals. And for example, technically on his proposals, no effective date has been stated, but there has been some talk of using the date of enactment or the date of filing as the effective date, rather than January 1, 2022, as Bernie Sanders' bill proposes. His proposals also focus on raising income taxes on higher earners. So it's a little different scenario than Bernie Sanders' bill, which is more focused on people with wealth, although obviously high earners often have wealth. His proposal would reduce the estate tax exclusion to $5 million or maybe $3.5 million. Again, if $3.5 million, and either way not indexed. If it's $3.5 million, it would reduce the estate tax exclusion to $1 million, just as the other bill, again not indexed. It would increase the estate tax rate from 40 to 45%. So not as big a jump as the Bernie Sanders bill. One of the more controversial parts of the statute, though, is that it would increase the estate tax rate. I'm sorry, it would end this death step up in basis on gains over $100,000. Right now, most estate planning is focused on using the estate tax exclusion, the $11.7 million, as a way to eliminate capital gains on assets that are being held by the person who's died. So if someone has an $11 million estate and it's made of $10 million of Apple stock that was purchased for $1 million, when that person dies, their estate is still under 11.7 million, so they have no estate tax. But the $9 million of capital gain built into the Apple stock is wiped out because it had been subjected to the estate tax, and it used the exclusion, but we didn't exceed the exclusion, so there was no estate tax, and the capital gains tax was wiped out. What the president's proposal would say is of that $9 million of gain on the Apple stock, only 100,000 would be excluded. And then everything above that, the $9.9 million of capital gain would be taxed at death. So that's something that people need to be aware of, because it's a major shift in the way estate planning is done today. The other thing that's talked about is just having a tax on all unrealized gains at death. This is similar to the Canadian estate tax. And basically, it's just a capital gains tax at death. So all of your assets get taxed based on the value less your basis in those assets. And the other thing that his proposals would do is eliminate Section 1031 exchanges. And that can be helpful if someone wants to defer estate tax. It doesn't eliminate, a capital gains tax, doesn't eliminate the capital gains tax, but allows you to defer it by swapping out a property. And then only when you finally ultimately sell property that's been replaced for cash, then you pay the capital gains tax. Eliminating that eliminates the ability to keep deferring the tax until maybe the capital gains rate goes back down again, because some of the president's other proposals are to raise the capital gains rate to as high as 39.6%. And then the other thing I would note, and we'll move on, is that these proposals are not vetted for cost or revenue. So it will be much harder to drop these into a bill than the current situation. So let's talk a little bit about the things that are more likely to happen. One is restrictions on GRATs, or Grantor Retained Annuity Trusts. Another is there'll be some increase in the top rate for gift and estate taxes. And then finally, some reduction in the $11.7 million gift and estate tax exclusion. And I say that they're more likely to happen for many reasons, but one is simply just that they would generate revenue for the government. So let's talk about the GRATs first. First off, what is a GRAT? It's an irrevocable transfer of assets that are likely to appreciate in value. That's where you get your benefit. It's an asset that's appreciating, and you want to get this future appreciation out of your estate. You transfer the asset to a trust. You retain a benefit for a certain term of years, so it's like a life estate in the asset, with remainder typically to your children in trust. Typically this is to children, not to grandchildren, because the way the GST tax works, the generation skipping tax works, is you can't allocate exemption until the end of the term, and by then you've lost the benefit of the technique. So typically this will just go to children, or outright to them, or in trust for them. And basically what happens is, because you retain the life estate, you reduce the total value of the gift, and so you've not used up as much estate and gift tax exclusion as you would have, and they're preserving it to use it against other assets in the estate that maybe aren't qualified for a GRAT or other techniques. Obviously, you need to outlive the term, because if you don't, the way this works, the asset's included back in your estate. But if you outlive the term, then the asset is as if it was never in your estate. The other beauty, because it's an annuity trust, is the asset's only appraised once at the beginning. Doesn't have to be revalued every year. Once it's valued, the amount of the annuity payment each year is fixed, and then that's paid out of the trust to the creator every year. And so even a hard to value asset, if you can get it valued once, then it could be a candidate for a GRAT. Most typically, people put in GRATs usually stocks that they have in a brokerage account. That's the most typical, or an investment they have, in a particular investment that they have privately owned, stock that they privately own. And just give a quick example. Let's say you have an asset that's fair market value is $750,000. And you have a 33% valuation discount. So now your asset that you're trying to get out of your estate for gift tax purposes is $500,000. And in this example, I'm going to assume 4% growth, which again, the best assets are assets that are appreciating rapidly. So if it was appreciating at 10% per year, then these numbers would be look even better than they do in this example. But at 4% growth, because I'm going to be conservative and just show how the technique works. We're going to assume that the donor is 60 years old, and that the donor is going to retain a right to the asset for 10 years and take a 5% payout. When you set up that type of GRAT, the numbers work out to be a gift of about $265,000. So you've got an asset that's worth $750,000 out of your estate if you live the 10-year term, with a gift that's only $265,000. So for a third of the value of the asset, you're getting this asset out of your estate. Now, over the life of the 10 years, the grantor will receive $250,000, but the remainder in the GRAT at year 10 is $752,000, and that's $752,000 of assets that are out of the estate at a gift of only $265,000, and you had $250,000 of cash along the way. This kind of technique can be optimized to reduce the size of the gift, but again, you need a high income asset. At 10.7% instead of 5%, the gift is zero, as an example. But in that example, you'd only get $217,000 out of the estate, because of the funds that are coming back to you in the 10% retention. So let's talk a little bit about the things that are likely to happen under the estate tax laws for the GRATs. One is to require a minimum 10-year term. So in my example I just gave, still works perfectly fine, 10-year term. But if my client comes in and my client's 78 years old, and we want to do a 10-year term, depending on the client's health and family history, they may not make it to 88. And so you have to start deciding if that's going to make sense. That's not the law yet, but if that's one of the things being talked about, and it's been talked about for quite a while. The other is to acquire a minimum remainder to be passed on of the greater of 25% or $500,000. So again, that number is going to that's going to affect different deals because of that. So the GRATs can be advantageous, as I showed in the prior example, but the changes will eliminate short-term GRATs. And will also eliminate laddered GRATs. And what a laddered GRAT is you may do 5 2-year GRATs, and you'll do 5 GRATs. One is for a 2-year term, one's for a 4-year term, one's for a 6-year term, one's for an 8-year term, one's for a 10-year. The idea is well, if I die in year 10, all 5 GRATs worked. But if I died in year 7, well, the last 2 GRATs won't work because I didn't live to be 8 years or 10 years. But the first 3 GRATs, so 60% of my transaction, did work because I did live 6 years, 4 years, and 2 years. So that's that there will be an impact on ladder GRATs because you have to have a 10-year term. So now you'll be doing 10, 12, 14. Might work for a young client who had a really highly appreciating asset. Doesn't work so well for the older clients. Officials in the Biden administration, these changes are from the Bernie Sanders bill, but officials in the Biden administration do favor curbing the use of GRATs. So that's that. Then another thing that's more likely to happen is an increase in the gift and estate tax rate. As I said, the proposal from the president is to raise it to 45%. It has been 45% in the past. It's been 55% in the past. It's been as high as 90%. So, but that's several decades ago. So you're raising it to 45% and kicking in a few $1 billion of revenue for some bill, it could happen. And then that increase, where you hit that, because the rates are graduated, they start at 18% and they go up to 40%. That increase going from 40 to 45% means that when you have assets of more than $1 million, you'll start to pay the higher rate. And less likely, but I do want to point this out because it's in the Sanders bill, is there's a surcharge rate of 50% as opposed to 45% for estates that are over $10 million. The rate raises to 55% if the estate's over $50 million. And the rate goes all the way up to 65% if the estate is over $1 billion. And Bernie Sanders points out in his bill, well, the top 1% of Americans, and that's 3 million, roughly 3 million people, own more than the bottom 92% of Americans, which is about 300 million people. And so his thought is this is a way to have a wealth tax, but do it through the estate tax, which is already constitutional. The wealth tax, there would have to be a change to the Constitution probably to make it work. And then the other thing that's more likely to happen is to raise the gift and estate tax, reduce the gift and estate tax exclusion. As I mentioned before, the Sanders bill reduces that to $3.5 million, not indexed. And just as an example, over 10 years, you can expect, that inflation would reduce that to $3.5 million to maybe even $2.5 million, and over 20 years, that number could be the equivalent to $1.5 million of assets today. And then as I said, the Biden administration has suggested reducing the gift tax exclusion. Just haven't picked a number yet. And then just want to remind you, under the existing law, no change needed by Congress, no bill signed by anybody, the estate and gift tax exclusion is scheduled to drop by half to $10 million in 2026. Now, the $5 million is the number it was when it was first passed. but it's indexed for inflation. So in 2026, it's expected, notwithstanding the recent inflation, that number will probably be about $6 million. This is very likely to happen, and everyone should be planning for that reduction to happen in 2026. And the reason is there's no action required by Congress. Literally, if nobody does anything, the law sunsets, the exemption is cut in half, indexed for inflation, everyone will have about a $6 million exemption. So let's talk a little bit about the things that are not as likely to happen, just so that you're aware of them and know that they're out there, because things could happen. One is a limit on valuation discounts. Another is to change the Grantor Trust rules. The third is to replace the step-up basis rule for estate tax purposes with a carryover basis. And then, sort of, to me, the most dramatic in terms of planning is impose a generation skipping tax every 50 years. And we'll talk some more about that as we go forward here. So again, these are not as likely to happen, and there are reasons for that. But one, this limiting valuation discounts is for non-business assets. So where you have a trade or business and you're trying to do some like family limited partnership planning, where you want to transfer the future appreciation to other family members, those discounts are still available. So the lack of marketability, minority interest, those kinds of discounts, blockage, those are still available. But when it comes to non-business assets, so you have a portfolio of investments or real estate that's just investments, this is where they would say, okay, you're not allowed to use valuation discounts. And part of the reason is the example where I gave earlier with GRAT, we were getting a $750,000 asset out of the estate using valuation discounts of 33%, which is not unusual. And so a third of the value of the asset was not even subject to the estate and gift tax regime. And so that's one of the reasons for trying to do away with these valuation discounts. And as I said, this applies both to donors for lifetime gifts and for estates. And then there are going to be some tricky rules there, because where entities own other non-business interests, there's a look-through rule, and that ownership in other entities can be as low as 10%, where you start to look through to see if those discounts are going to be allowed at all. So another thing that's not as likely to happen, but would have a dramatic impact on estate planning, is the changes in the Grantor Trust rules. Right now, we have this ability to include certain powers in a trust that cause it to come within the income tax rules and for the trust to be treated as a Grantor Trust. What that means is that whoever the grantor is, and typically it's the person creating the trust, but whoever the person is who has the powers that cause it to be a Grantor Trust is taxed on the income of the trust. And then for income tax purposes, the trust is deemed to be the grantor. And so when you do transfers between the grantor and the trust, nothing happens. And so you can sell something to the trust and it's not treated as a sale. There's no capital gains implications. You can deal with the trust as if it doesn't exist, almost like a disregarded entity, if you're used to that parlance. And so there's a lot of planning you can do because of the disconnect between estate and gift rules and income tax rules to get assets out of the estate. And then the beauty of the Grantor Trust is that the income is being taxed to the grantor, who typically has more assets than the beneficiaries of the trust. And so it's like an additional gift without being a reportable gift. As I sort of say here on the screen, if it loses Grantor Trust, then the assets are treated as a gift. And so then you have a gift event, which is different than the way we think of our Grantor Trust. And then the assets in the Grantor Trust are included in the grantor's estate, which again, a lot of times these trusts are set up to not be includable in the estate. So that's a big change. And then it makes clear the rules, these proposed rules make clear there's no step-up in basis going to be allowed for transfers to Grantor Trust unless the trust is included in the estate. And then finally, gift tax or estate tax is imposed is a liability of the trust. So now the trust has to pay for it. Again, that's not what people were hoping for. So not as likely to happen because it's a pretty complicated set of changes, and it affects a lot of existing planning without really any opportunity to correct it. So not as likely to happen, but you need to be aware that these are being talked about. And then finally, the last thing is to replace step-up basis rule for estate tax purposes with carryover basis. It's not as likely to happen because, again, it's a pretty dramatic change in the way we do accounting for things. And it's also very hard for people to plan other than making sure they write down very clearly what the basis is in their assets. Like donees of gifts under current law, the change would leave beneficiaries of estates with the same basis as the person who died. And so the result is the capital gains tax is deferred rather than wiped out. So just like a 1031 exchange defers the gain until the asset's later sold, now if you inherit an asset, if you don't sell it, you just get the carryover basis. But then when you sell it later, you sell it and you deduct the basis that you inherited it at. And of course, if you don't know or can't prove the basis, then your basis is zero and you'll pay gain on the entire amount. So this is in addition to the other proposal, which is even less likely to happen, which is to have just tax all the capital gains at death, kind of like the Canadian style tax. But it's certainly a possibility. And then finally, imposing a generation skipping tax within 50 years. And so a GST trust is designed, think of it like the Rockefellers and Kennedys. They set up these trusts and then the funds are paid out for the benefit of the children of the person who set up the trust. And then when those children die, it goes to the grandchildren, and when those children die, then the great-grandchildren. And each generation is inheriting the benefit of this wealth without ever paying estate tax when they die, and only paying income tax on the assets of the income they're paid while they're alive. And so, as we said, the Kennedys and Rockefellers used to do it, and then it started to become very popular in a lot of states. As state after state started changing their rule against perpetuities, because up until then, most states had a rule that you basically couldn't have a trust last longer than about 90 years. It was basically the lives of the people alive at the time, plus 21 years, and plus a whole bunch of other weird rules that only nerd lawyers really want to figure out. But states started raising that number. And for example, Florida raised that number to 360 years. And so we would set up a trust, and the benefit to the family is that as each generation inherits the benefit of the wealth, they're not going to pay estate tax. So you don't get an estate tax hit on each generation. But you have to make sure that you come within the generation skipping rules, because in addition to the estate tax, there's a GST tax, and it's a flat 40%. And that's in addition to the estate tax. So again, there's planning we do to use up our GST exemption and to have these funds be exempt from GST tax, and then they'll go forward for 360 years, never paying an estate tax. The other benefit, of course, is that those children don't own the asset, so their creditors and a divorcing spouse also have a hard time getting at the asset. So it sort of protects it from the beneficiary. And of course, if the beneficiary is going to waste it, drugs or whatever, then that's another protection for them. The proposed change is to say, well, there's sort of three rules, and I outlined them here. GST trusts that are created before the date of enactment are grandfathered for 50 years. So anything that, say this law change happens at the end of the year, effective for January 1st, then we are going to go 50 years, and then the trust will be taxed, GST tax. That's not what we were expecting, because under the old rules, we were able to go about 90 years. So, I mean, this is really cutting that down. Now, for trusts that are created after the date of enactment, the terms have to say it terminates in 50 years, which again is completely opposite of what we've been doing. But if the term doesn't say it's for 50 years, then the tax is immediately. So again, pretty draconian changes designed to stop pushing wealth down to lower generations without paying an estate tax in this regime about every 50 years is the goal. So I think with all that said, we should talk a little bit about some techniques that provide some flexibility. Because, you know, when these proposals first came out in March and we all picked up the papers and we all picked up the different websites we look at in our research, we thought, oh man, this is a lot of different changes. And then everything seemed to sort of go in slow mode, and not a whole lot's been happening. Committees have been reviewing things. It's moving along as legislation, but it's not moving very fast because there's a lot of other stuff on the table in Congress, and the August recess is coming up pretty close. But unfortunately, that doesn't help us as planners decide how do we deal with this, because maybe we're dealing with the current law and we know what that is and we're planning for 2026, or maybe we're planning for some really unbelievably dramatic change. And a lot of these are tax changes, so they would only need 50 votes in the Senate plus one, so they could possibly be passed by reconciliation or as part of a budget bill. So again, what do we do? And then some of these techniques I want to talk about, they're not exclusive and there is some overlap. So, you know, you just sort of have to pick and choose and figure out what's going to work for the family. But some of the things we'll talk about are formula gifts, loans to family members or a trust for a family member, some built-in disclaimer planning, some QTIP election planning, including spousal lifetime access trust, intentionally defective grantor trust, and then charitable remainder trust, and then a Section 1031 exchange, and doing that, you know, obviously sooner than later. All these techniques probably need to be done sooner than later. So I'll start with the formula gifts first. Basically, you make a gift now before enactment, but it's not a dollar amount gift. It's a defined dollar amount or a fractional share of an asset, but using values as finally determined for gift tax purposes and tied to the amount of the gift tax exclusion. So your formula is tied to the amount of the gift tax exclusion. It does require some very special drafting. It's not based on settled law, but it's similar to a marital deduction funding clause, where we'll say, I want this trust to be funded with the largest amount that will result in no estate tax being applied to my estate because of the exclusion amount and the marital deduction. And so you end up with a zero estate tax at the first death. Similar to that, it's a formula that says, okay, based on whatever the exemption is, because remember, this law could be effective prior to the date you make the gift, if you make it today. And so, and there's some special drafting there, but it's tied to whatever the law is, so that you're not caught flat-footed if the law changes on you after you've made the gift, because you're not reporting this gift until between April and October of next year. So you make the gift in 2021, you're not filing the gift tax return until 2022, and that's when you will know the numbers. So it's helpful. It's a helpful technique. Another one that's doesn't take a whole lot of planning, really, is to make loans using our historically low interest rates right now. Because if you do a 9-year promissory note from your beneficiary or from a trust for your beneficiaries, the rate that you're required to charge is just over 1%. So it's very, very low cost to do this loan. And then you can combine that with an installment sale or a self-canceling note, so that over time, this asset is completely out of your estate. And then if the gift tax exclusion is lowered retroactively, so it is lower than this huge gift that you did, or this huge loan you just made, then you don't do anything. And then it stays, but the law doesn't change, then you have the option to forgive the principal in the future. And so it can be an effective technique. So one other concept is to do trust with built-in disclaimer planning. And again, what you're trying to do is say, look, I know I have 9 months to make a disclaimer from when I make the official gift. So the beneficiary has 9 months to make that decision. So a gift made in July, you have until March of next year to figure out what you're going to do. So you make this large gift and trust for beneficiary, and the trust has provisions that say if the beneficiary disclaims the assets, they revert to the grantor. So we're basically undoing the gift. If the gift tax exclusion is lowered, then report the gift and use up your larger gift tax exclusion that you just used. If the law doesn't change and your beneficiary is cooperative, they can disclaim the gift and the assets come back to you. And so you're still functioning with all your assets and you still have your larger estate tax exclusion. And then, as I said, you have 9 months from the day of the gift to make that decision to disclaim. So the disclaimer you have to make within 9 months of when you get the benefit. And so again, a July gift, you have until March. Obviously, a November gift, you would have until August to make that decision to disclaim. And that gives you some time to do some planning based on what the law is when we get to next year. Another type of planning is QTIP election trust planning, and this is where you are. There are certain types of trusts that don't qualify for the standard marital deduction, and for those, you have to elect QTIP treatment. So that means that you have the ability to decide whether you're going to take the QTIP treatment or not, and again, tied to a gift tax return. So you've got some time. To do that. So you make a large gift and you make it into a trust for a spouse, and you make sure that the trust has terms that allow a QTIP election. So in the future, when we're talking in the next few months, if the gift tax exclusion is lowered, then you elect a QTIP treatment, and then there's no taxable gift to the marital deduction. If the law doesn't change, you don't elect the QTIP treatment. So there's no marital deduction, and it's a taxable gift. And so now this larger gift you made in 2021 uses up exclusion that existed in 2021 that doesn't exist in 2022. And as before, you make this decision as late as October 15th of the year following the gift. Again, assuming that you extend your income tax return from April 15th to October 15th, then you will also have until October 15th to make that decision on your gift tax return, whether there's actually going to be a gift there or not. Now, the key to a QTIP trust is that all income has to come out to the spouse. There can't be any other beneficiaries. It can only be for the benefit of the spouse. And the principal can only be distributed for health, education, maintenance, and support. And then there are no powers over the trust to change it or affect it in the future. So something to keep in mind, gives some flexibility and works well as long as the couple is happily married. Related to that is another type of marital deduction trust. It's a spousal lifetime access trust. And again, you're making a large gift to a trust for the benefit of the spouse. And sometimes these gifts, I keep saying we make a large gift. One of the downsides of the way the law works is if it drops by half, you have to have made gifts to get the grandfathered extra amount above the 5 million all the way up to the 10 million, currently 11.7 million index for inflation. To get the full benefit of that extra half above the first half that maybe dropped down to, is you have to actually use it before the number is reduced. So if you have a client with an $11 million estate, they need to make, to get the full benefit of their $11.7 million exemption, they have to make a gift for $11.7 million. So we're talking about pretty large gifts here on some of these, if you want to preserve the full $11.7 million. Let's say, for example, that you made a gift of $8 million and the exemption dropped to $6 million. You'd still have $2 million grandfathered. You just would lose that extra amount between $8 million and $11.7 million. So we are talking, and then because these are such large gifts, that's why these techniques with some flexibility built into them are kind of important. Now, the access for the person who creates the slat's indirect, because it's basically, well, if my spouse is getting the benefit of this trust, hopefully my spouse will share it with me. So obviously there's a risk if there's a later divorce, or if that spouse predeceases the person who set up the trust, because obviously once the spouse who's the beneficiary of the slat dies, the trust goes on typically to descendants of the grantor. So you could also have this asset completely go away if the spouse predeceased you. So there's some risks to this. So if the law changes, and if needed, then you elect QTIP treatment, so there's no taxable gift due to the marital deduction. and the asset is out of the estate without using gift tax exclusion. And I say if needed, because sometimes you can set these up so that there's very little gift anyway. And then if the law doesn't change, you don't elect QTIP treatment, so there's no marital deduction, and you end up using up this prior larger gift exclusion. And as before, this decision can be made on October 15th of the year following the gift. So you have time to decide, okay, which way am I going to go on this gift? So another technique that doesn't even use or uses not very much estate tax exemption is the intentionally defective grantor trust. And basically the way this works is that it's an odd name, but basically we're saying we're going to put in something in here that makes this intentionally work our way into the grantor trust rules. And it's a sale, it's not a gift. And so other than the trust that you set up to buy the asset, and you'll need to put some cash in there, and there's different amounts. We usually suggest 10% cash into that trust. So there'll be a taxable gift for that. But that's just so that the trust has some financial wherewithal to actually make payments on the promissory note that is giving to you or to the donor in exchange for selling the asset. Because it's a grantor trust, it's treated as if nothing happened and there's no sale. So even though it's a sale, all the documents are a sale document, there's promissory note, it's closing statement, there's not an actual sale. It's just because of the grantor trust. Now, if you remember, I said earlier, they're talking about changing the grantor trust rules, basically not to allow this sort of thing to happen, and to basically cause it to either be a gift or to be a sale. So this is the kind of technique that can work now until they change the rules. But as long as you follow all those formalities, the trust is sufficiently funded to actually be a legitimate, be credit worthy to make the note, and as long as it makes the payments on the note, then you've gotten this asset out of your estate without having to pay capital gains tax on the asset. Now, it will have carryover basis because it's not included in your estate, so there's no step up in basis. But you did get the asset out of your estate. And it's a technique we often use when someone has used up all of their exemption. If someone comes to you, let's say they change the rule to $6 million exclusion, someone comes to you and their estate's worth $20 million and $15 million of that is a business, it's going to be very hard to get that business out of their estate when they only have $6 million of exclusion. And so sometimes an intentionally defective grantor trust sale can provide that kind of flexibility to get the asset out of the estate. And then it also, it works great now. Let's say that we've used up all our exclusion, our current exclusion, then we can keep on getting assets out of the estate without using more exclusion, or we can do part sale, part gift, and use up some exclusion. The only catch is this may not work. Intentionally defective trust may not be available if they change the grantor trust rules in one of these statutes. If they don't change them, then this will still work going forward if the law changes and the exemptions are reduced dramatically. So another concept is a charitable lead. I'm sorry, a charitable. Well, wait, what am I saying here? It says charitable remainder trust. But I'm sorry. I'm reading my notes wrong. I apologize. A charitable remainder trust. And basically, here you transfer assets to a trust and you retain income from the assets for a term or for a lifetime, and then the remainder passes to charity. And then because the remainder passes to charity, there's no estate tax. And so you've gotten an asset out of your estate without paying estate tax using the lower exemption amount. And then the other benefit is either you as a donor or your children, but there will be a gift for the interest you pass to your children, get the benefit of the funds coming from the asset for their lifetime. And then only later is the asset out of the estate. So if you do a CRAT, a Charitable Remainder Annuity Trust, there's no ongoing need to evaluate the value of the asset. However, if it's a CRUT, a Charitable Remainder Unity Trust, which is a % of the assets at the end of each year, that's a hedge against inflation, but you have to revalue the asset every year. So if you have a publicly traded stock in there, that's easy. Do the Unity Trust, and you know you'll be protected against inflation. If it's a hard to value asset, you do the Annuity Trust, and then you don't have to keep doing appraisals every year. You just do it one time, lock in the amount. The amount's locked in, so if inflation starts to eat into that, you don't have a hedge against that. The other thing about a charitable lead trust is that you can zero out the gift. So you can end up not even, based on the way you time it, you may not even have to pay, there may not be a gift on the transaction. So it's a way, using the remainder trust is a way to say, look, I want full benefit for me and my family for my lifetime of my assets. I don't want to pay estate tax at my death. And oh, by the way, there's this charity I really would love to benefit. So instead of some of that money going to estate taxes to the government, all of it goes to the charity you want to benefit. And during your lifetime and your children's lifetimes, they're getting the benefit of the funds. So something to keep in mind. And then last is the 1031 exchange. And really the reason I bring this up now is because it defers capital gains tax. And that can be valuable if capital gains taxes end up being raised in the future, especially if the rate gets raised retroactively. I mean, that's one of the problems with planning right now is everyone keeps saying, well, we're going to make it date of enactment, or we're going to make it date of filing with the clerk of the Congress. Well, we're past those dates. So if we do stuff now, but we don't know if the law is going to change, we don't know how to plan for it. So the 1031 exchange can let you, can do that, especially if rates are raised in the future. Now, retroactively. There are reasons you don't do 1031 exchanges. This isn't a 1031 exchange seminar, so I don't want to get too deep into it. But obviously, if you have capital losses, then you want capital gains so that you can take them against your losses. If you have net operating loss carryforwards, again, you want capital gains so you can take them. You can take those carryforwards. And then sometimes you want to increase your basis. For example, if it's a type of asset where you want to be taking depreciation to reduce the income going forward, you may want to recognize the capital gain, so you get basically a step up in basis, and then you can take depreciation against that going forward. So, and then again, this is not a 1031 seminar, but basically for a 1031 exchange, you have to have a sale or exchange. You have to something you're selling. So you need to, and typically there are some related party rules. So typically you're selling it to an unrelated person. It needs to be real property that can be investment, but it can't, or being used in a trade or business, but it can't be something like if you're a developer, then real estate for a developer is inventory. Can't be that type of property. It has to be exchanged for like-kind property, but that's kind of a misnomer because you can trade investment property for trade or business. So it's like-kind just means another kind of real property. Now you do have to identify the real property within 45 days of the sale, but you can identify multiple properties. And then you have to purchase that replacement property within 180 days of the sale. And then I make a note, or by the due date of the tax return if earlier, because there's a way you can get yourself sort of caught between your due date and the 180 days. So you always want to run those numbers before you decide you're going to do a 1031 exchange. And then I want to talk about some techniques that no matter what the law says or what happens to the law, you're going to be able to keep doing these, at least based on what people are saying right now. And those techniques are the Charitable Lead Annuity Trust, sometimes called a CLAT, a Qualified Personal Residence Trust, sometimes we call them QTIPs, which in the old days were called GRITs, and then a conversion to a Roth IRA, and then making annual lifetime gifts. Again, these are all techniques that are still powerful and can be used for estate planning no matter what the law says. And that's sort of where we're at now in estate planning, is that we're sort of looking at what do you need to accomplish? What can we do, one, that's probably not going to change at all, and start with that. And then what are some other things we need to do if we still need to get assets outside of the estate tax realm. So charitable lead annuity trust is the opposite of the charitable remainder trust that I was talking about earlier. Here, the charity gets the interest up front, and then the remainder goes to the beneficiaries. So you have an irrevocable transfer into a trust, and it's usually assets that you think are going to appreciate in value. And so basically during the lead term, the charity gets the benefit of the assets, and then the remainder goes to family. And so that preserves the estate. The reason we're doing this is we're getting this asset out to the family at a lower use of exclusion amount. That's the purpose. That's the purpose of doing the CLAT. We're not trying to completely eliminate estate tax, but we're trying to do it at a discount. So if the law changes, the assets out of the client's estate, and they may even get an income tax deduction, typically they do, which would help since it looks like if the law changes, income tax rates are likely to go higher. If the law doesn't change, well, the assets are out of the estate, with the possibility of using children's estate tax exclusions and GST exemptions. So they will preserve them for the children, or actually stepping it down to the children for them to use those exemptions. And then because it's an annuity trust, the asset's only valued once, so it could be a more difficult asset to value. It doesn't have to be revalued every year. And so that can be a helpful technique, particularly if you have a charity you want to benefit, and even more particularly if you have a charity where during your lifetime you would like to see them use and benefit from it. It's a little different. A charitable remainder trust, the charity doesn't get the funds until the end, which is not as helpful. So just give you an example of how a CLAT would work. Let's say we have the same asset, $750,000 in value. It's allowed to have a 33% valuation discount. Again, I'm assuming 4% growth. So same fact pattern as the example I gave for the GRAT earlier. And we're going to set it up so that it pays out the income for 10 years to the charity and then remainder to the children. So on that scenario, there's an immediate charitable deduction of $351,000. And then the remainder taxable gift to the children, because you're giving something to the children when you set this up, is $398,000. But in the process, you're getting $660,000 of assets out of the estate. And the reason why you get the 750 and the 660 differential is because there is some money going out to charity during that 10-year term. And so again, a CLAT can be helpful, and there's no talk about changing that or changing the law right now. And it also generates income tax deductions, which can help people since there's discussion about increasing the income tax rates. So another technique I mentioned earlier is a qualified personal residence trust, QTIP or GRIT. This is an irrevocable transfer of a personal residence, and it can be the primary home or it can be a vacation home to a trust. And so with a married couple, you can have as many as four. You could have as many as 4 QTIPs, 2 QTIPs, husband and wife each for a home, the primary home, and then vacation home, husband and wife each half of the vacation home. You retain the benefit to live in the house for a term of years, with the remainder typically passing to children in trust. Again, as I said before, like with the GRAT, not useful for gifts to grandchildren because, again, that initial term prohibits you from allocating GST exemption until the end of the term. And by then, the house is appreciated in value, and the whole point of the transfer is to get the future appreciation out of the estate. So again, the QTIP will reduce the total value of the estate and let you use that exclusion for other things. That's why you would do a QTIP or a GRAT, is you're trying to do discounted gifts so that you don't use up all your exclusion, so you can use it on other assets that may not be as ideal for that sort of technique. Again, as with the GRAT, you have to outlive the term. Otherwise, the cost to set it up, you've got it, you can't get around that. But if you don't outlive the term, just with the GRAT, I mentioned this before, you get, if you used up exemption or exclusion, you get it back. So if you don't outlive the term, it stays in your estate, but you also get your exclusion that you used to set it up back. The asset only has to be appraised at the beginning. It doesn't have to be revalued every year. If you get to the end of the term, you don't have to move out because most GRATs, most QTIPs, we put wording in there that allows you to continue to live in the property as long as you're paying fair market rent. Now that can be, again, that's a helpful technique, even though it sounds like, well, I don't want to pay rent on my own house. But what you're doing is you're paying rent to the trust, which is for the benefit of your family, your kids, and it's as if you were making a gift to them, but it doesn't count against your annual gift tax exclusion. So it can be a very helpful technique. And so you don't have to feel bad that you're paying rent on your own house. The other thing that you can do is swap out the house. You can either swap it out for the same value, or you can drop down the amount that's subject to the QTIP. Say you put in $1 million home, and then you decide, you know, this is way more house than we really want to live in. We want to buy another house for $600,000. The QTIP can buy the house, swap it out for the other house, and then the extra $400,000 that's there when you sell the house turns into a GRAT, and then it'll pay out the same way that a GRAT would work. So you can even downsize the house, and the technique still works, and you still get the benefit of what you're trying to do. Obviously, if you sell everything, it's not a QTIP anymore, and then it becomes a GRAT for that entire amount. Now, another technique that can still be used that we're doing these days is a conversion of an IRA to a Roth IRA. And as hard as it is to pay income taxes now, that's the point of the conversion, is to pay the income taxes now when income tax rates are lower. And then later, when the distributions are taken, the Roth IRA is not taxable. Later, when the rates are expected to be higher. So we're paying income taxes now to convert it, to use lower income tax rates, so that we can take out the funds later when rates are higher and it not be taxable. Now, when they inherit the Roth IRA down the road, they still have to take the distributions out within 10 years. The Secure Act is still in place. They can't get a lifetime stretch, it's just to 10 years, but they won't owe any income tax. So unlike your current IRA, if you don't convert it, they inherit that IRA. They have to take it out over 10 years, and they have to pay the income tax over those 10 years. So basically what you're doing is you're paying a discounted income tax now on behalf of your beneficiaries, and the taxes are reducing the size of your estate. So again, I say there's not an all or nothing approach. It's a multiple different techniques, and you add them all together to see how to get the estate reduced as low as possible. And now a client doesn't have to take RMDs on a Roth IRA, but the account will still have to be paid out over 10 years. So what you don't take out will have to be paid out over 10 years. And then the last techniques that still works is annual lifetime gifts. And they can be outright to family members or to a trust that has crummy withdrawal powers. And basically a crummy withdrawal power converts a future interest gift, basically, because the trust is a future interest, to a current gift, and then it qualifies for the annual exclusion. And most typically we see those in life insurance trusts. And then what we're trying to do is leverage the lower market value of assets right now, and the theory that asset values are going to go up over time, either by inflation or by the economy recovering. And the effect is you're packing $15,000 per person with undervalued assets that will appreciate in the future. And as long as it's $15,000 per person per year, you're under $15,000. There's no gift tax return required, and you can pay unlimited. And you can do that with unlimited numbers of people. So you could do this with 10 people and get $150,000. I'm sorry, with 10 people, get $150,000 out. And people forget this. You can pay unlimited amounts above the $15,000 directly to a healthcare provider or to an educational institution for tuition. So you can do a lot for your grandchildren that way. In conclusion, my suggestions are, don't be complacent. Some kind of changes are coming, either this year or next year before the 2022 elections. and no matter what, for sure, on January 1, 2026. It may seem like Congress is divided, but deficit hawks want to raise revenue and Democrats want to pay for programs. Very strange bedfellows, but it's a recipe for change. The date of the enactment means that some of the techniques might not be available even later this year. And no matter what, as I said, 2026 happens without any action by Congress or the president, and it means everyone should be doing planning right now. Thank you very much.